Well, energy is the worst performing sector this year, but the best performing sector this month. Will the September rally rage on? Joining us to discuss is Raymond James energy analyst Pavel Molchanov and Cowen senior energy analyst David Deckelbaum. Good afternoon to you both. Pavel, I'll start with you. The fact that energy stocks are up something like 2.5% week to date, they're up for the month so far, even as Brent and WTI have weakened. Why the divergence now?
Well, let's zoom out a little bit. As you said, energy is worst performer year to date. It's actually underperformed in 8 of the last 9 years. And in fact, energy's weighting within the S&P 500 is at the same level as it was in 1999 when oil was less than $10 a barrel. Of course, oil's about 6 times that today. So the fact is, energy stocks and the commodity have been diverging, and they diverged in the first half of this year when oil went up, but the stocks didn't do much. So we're seeing a little bit of a linkage kind of reviving, which is very healthy, and we need a lot more of that, but it's just a start.
David, you don't see the recent rally in some of these energy stocks as particularly justified?
I say that, to Pavel's point, I think that this is susceptible to be happening when you have an index that has a minuscule weighting. I still think that there's plenty of reasons to doubt that we're going to exceed $55 a barrel next year. You have almost 700,000 barrels a day of new projects coming online outside the U.S. in the next several months. We've seen demand trending close to 1 million barrels a day. And we still see Permian capacity expanding in the back half of this year, which should fuel a little bit more onshore growth into 2020. So I think you look at global supply-demand balances, it doesn't necessarily paint the most bullish picture in 20. And I think for the stocks particularly, you're transitioning now from a growth sector to still into an income or value sector. I think that transition still takes quite a bit of time. And fundamentally speaking, I don't think there's a ton of reason to see this rally following through for meaningfully for several months.
Pavel, what is your target for oil over the coming months? Where do you think the price goes?
Well, short answer is we think it's going to go higher. Now, obviously, the trade war situation has been a headwind, no question. But let's remember, Iranian supply is down dramatically versus a year ago. Venezuela continues to fall off a cliff. And also in 2020, the IMO low sulfur regulations come in, which will further put a dent in global supply. So we think that oil should be setting cyclical highs in 2020, considerably north of where we are today, probably north of where we peaked this past spring, kind of 75 bucks a barrel. So there is certainly room for it to surprise to the upside, but it would help if the demand side of things became clarified once there is a trade deal with China.
Steph, you like Schlumberger?
I do.
Just oil services? You want the integrated as well? Or?
I kind of do the barbell there, too. So I own Chevron, Schlumberger, and then I also own Diamondback Energy, FANG. So I actually think this group so unloved, so under-owned. You saw what these stocks did this week just on the rotation, the value factor rotation. So if you believe, like I do, that the value factor rotation is going to get legs again, maybe starting next week, this group is under-owned and it won't take much. And if you have 55 oil, if you get 65 oil, that's quite good, especially for services.
David, the fact that we've seen the spread between Brent and WTI narrow in the last couple of months, I know some of that's been some infrastructure coming online out of the Permian here in the U.S. Does that make some of those infrastructure names, those pipeline names, look attractive right now?
I think the pipeline companies might be attractive, but I still think that we're probably in a situation where, unless the U.S. sustains the growth that it seems over the last several years, we could be in a scenario where we've overbuilt our infrastructure. And to your point, we are exporting a ton more barrels than we have historically. That does contribute to that Brent-TI narrowing spread, which we think is probably sustainable into next year. I don't think that there's very much call on future infrastructure at this point. So I'd look for that market to tighten up a bit more, I think, before looking to rotate out of other areas like the upstream companies.